Okay, so what we began to do is we began to talk about different trading strategies. Bear with me if you can hear the sound of rain. There's a heavy rain outside. All right, so that's why you're hearing sound of rain. Okay, so we began to talk about trading strategies, and then we started to talk about different kinds of traders, different types of traders. We talked about intraday traders, scalpers, swing traders, position traders, and all of that, right? So what I wanted to do after we've gone through all that, what I wanted to do is go through certain sessions where all we are doing is just analysis. All right, we're looking into different analyses, different charts, and then we are basically being able to look at a method of taking trades to get better entries. Because when it comes to trading, the number one thing you want to get right is entries. And then, of course, when you have your trading plan, you want to have your parameters for entry in your trading plan. What are my parameters for entry? What am I trading? And what are my parameters for entry? Because when the difference between a profitable trade and a trade that turned into a loss could just be where you enter the trade, could just be when you enter the trade. Because if you have a good entry, even if you have a drawdown, you are able to stay on that drawdown. You are able to, if you enter a trade at a good position and your entry is good, then your stop loss can be good as well, right? If I knew, for example, that this trade was going to sell, right? Let's say this trade, this is NAS 100. Let's say this trade is in the sell zone, right? This trade is in the sell, is a downtrend. Let's just say, for example, that this is a downtrend. Okay, let's not even do that. We can see it's an uptrend, fine. Okay, so let's look at something now. Let's say we want to enter this trade for a buy. We can see that is a buy trend, right? It's a buy trend. Nice. So we wanted to enter this trade for a buy. We wanted to enter a trade on NAS 100 for a buy. Now let's assume that at this point we entered this point here for a buy, and we're expecting price to move to somewhere here. Let's say somewhere this area, right? 13,500 is where we're expecting price to buy to, right? So now we have this point, and we got into a trade here for a buy, and then what we're expecting to do is we're expecting price to move from here to this point, right? That's what we're looking at. We're expecting price to move from this area here, okay? We're expecting price to move from here all the way to this area right here, right? That's what we're expecting price to do. That's what we're expecting price to do. But look at something now. We entered here for a buy, right? Now, price move. Normally, we are going to put our stop loss at maybe the next swing low, maybe under here or something like that, right? Depending on where we are depending on where we're on the time frame we're actually trading from, right? And what our risk parameters are and all of those things. There are several things that could come into play when it comes to determining where we are going to put our stop loss. For example, somebody who's trading off the 15 minutes, and is looking for a very sweet entry, like an entry that gives him very small stop loss, right? If you're a trader, you understand what I'm saying. You're looking for an entry that is so good that your stop loss is going to be so small, right? If you're looking for that entry, if you enter a trade here for a buy, you are most likely your stop loss, where your stop loss is going to be different from someone that enters this trade on a higher time frame, like on the 4-hour. This trade right now, this time frame right now is 4-hour charts. Okay, now when you enter that trade here for a buy, imagine that price now goes up here and starts coming down here, now comes to this point. And then you already know, it's like you are so sure that price is going to buy, and then you have to sit on this drawdown just so price can come to even break you even. That's crazy. You may not be able to do that. Your capital may not be enough. It depends on how you are trading. If you are trying to flip your account or something like that, you may not be able to sit on a drawdown that is this huge. So this is how many people find themselves in the market. Where your entry is not good, then where do you now place your stop loss? It becomes very poor. So that's what we are looking at. That's actually why I decided, okay, let's do some analysis sessions where we can look at entry and areas of entry, best strategies for you to get into an entry. Where do you buy? Where do you sell when you see a certain move happening in the market? Okay. So that's where we are going. So number one, in all of these things, the first thing you want to determine is, what are you trading? What instruments are you trading? I keep saying this, guys. The instrument you are trading is the first thing you have to determine. Of course, we talk about your trading plan. Your trading plan has to involve all these things. Your trading plan has to have all these things inside it. What do you trade? What is it that you are trading? Are you trading a Euro USD? This is Euro USD, for example. Are you trading GBP USD? Okay, GBP USD. Are you trading USD JPY? Okay, are you trading USD JPY? Are you trading NAS 100 or US 30? What exactly are you trading? What you are trading will determine to a very large extent exactly what you do, how your entries are. What you are trading exactly will determine what your entries will be. This is why we talk about it I talk about your entries as very, very important. What you are trading, what you put in your trading plan that you are trading. What is it that you are trading? Because now, if you adopt a Fibonacci strategy, or support and resistance, structure analysis and all that, if you adopt such a strategy, you have to understand something, that the way it plays out differs. It's general, right? The rules are general. The rules work generally. Okay, whenever there's a breakout, there will be a pullback, there will be a continuation. Whenever there's a breakout, there will be a pullback, there will be a continuation. It's just the way it is in the market. That doesn't change. But then, based on the instrument you're trading, there will be a couple of things that will change. Based on the instrument you are trading, there will be a couple of things that will change. For example, if you are trading Fibonacci and you take a Fibonacci tool and you draw Fibonacci from one area to another. Now, when there is a pullback, sometimes the pullback will come to the 50% retracement for some instruments. For some other instrument, the pullback will come to 61.8 retracement. And depending on where you are trading from, the distance here, the gap here, that means this pip amount between this area and this area can be very huge, depending on where you are trading. It can be very huge. So if, for example, you are trading one instrument and that instrument has a 50% retracement, that means every time there's a breakout, every time there's an impulse movement, there's usually a 50% retracement for that particular instrument. If you go and use that instrument, use that idea to trade on something different that has a 61% retracement level, you are going to have an issue, which means that you will see a trade happening. You will enter a trade at 50%, the market will push down to 61%. And it depends on how that, on where you are trading from. If you are trading, if the way you're trading, from where you are trading, if the distance between this point and this point is very high, that alone can make you blow your account if you're trying to flip your account. Or it can make you risk more money than you are supposed to risk or that you wanted to risk. So you have to know the instrument I'm trading. If I'm trading Fibonacci, where does this retracement come to? Is it the 60? Is it the 50%? Is it the 50%? Is it the 50% or is it the 61.8%? Right? So that's what you are going to determine. You determine that based on understanding the instrument that you're trading. Based on understanding the instrument that you're trading. right? So if you're trading GBP USD, for example, me personally, I trade USD JPY, right? Now I trade USD JPY. Even then, there are certain times where I have to look at several things to be able to make a full decision as to where should I mark off for this particular trade that I'm expecting, right? So that's what you have to look at. That instrument, you have to focus on one instrument and say, okay, this is what I'm trading. This is what I'm trading. For example, USD JPY, whenever there's a retracement on USD JPY, whenever there's a retracement, it will usually do 61.8. It will usually do 61.8. Now, there was a short time ago when this instrument would not, whenever it does a retracement, it won't do 61, it will do 50. This was just maybe 2 months ago or thereabouts, 2 or 3 months ago. It will do 50 retracement rather than 61.8. But now what it does is it does 61.8. How do I know that difference? Because that's what I trade, and I try to follow it. I try to follow it, because you cannot, as a matter of fact, you cannot follow 21 different instruments. I know a guy who said he used to trade 25 pairs. He will lose on this, lose on this, lose on that, lose on this, lose on that. The only reason why you'll be trying to trade so many different pairs is because you have fear of missing out. You think that one instrument cannot give you enough money. That's just the only reason why you're trading so many different things. And when you overall, after you've traded, you will realize that overall you've done the wrong things, which means that overall you will discover that you may make money on one instrument and lose it on another one. You may make money on one trade and lose it on the next one, because you're thinking, oh, I need this, I need so many different opportunities to make money. Okay, if I take gold, I take USD JPY, I take Euro USD, I take GBP, I take NASDAQ, all of them will make me money. That's what you're thinking. I trade Bitcoin too. I add Bitcoin to it. Bitcoin is buying now. Bitcoin is buying very heavily. So it's time to trade Bitcoin. Now, if you do that, it will look as though you are doing something that makes sense. Oh, let me spread myself. There are opportunities everywhere. That's true. But the thing is that you might discover that you are not able to follow the market properly, because the market, why do we study the market? Why do we do analysis? If anybody can just wake up and enter the market and make money, what is your analysis now about as a trader? What is your effort in analyzing the market? What is it now about? If anybody can just wake up, enter the market, buy and make money, sell and make money. So being able to follow the market, anybody can enter the market and buy or sell one-off and make money. Okay, you can enter a buy and the thing just starts to buy, not because you did any analysis. So it doesn't take analysis to make money one time. But it takes analysis and understanding the market and following the market to make money on a consistent basis. So when you see somebody who's making money on a consistent basis, it's not a fluke. It's not something that happened just by chance. You don't make money consistently in the market by chance. That's just the fact. That's the way it is, right? So what you want to, that's the reason why you want to follow a particular instrument, follow what you are doing and be able to understand exactly what it is. For example, I said when you are trading USD JPY, if you're trading USD JPY, you are going to be looking for a 61% retracement. Here's what I'm talking about. Let's remove this and see what I mean. Okay, so now, you can go up and on, you can go on and on and on and on and back test and check. The 61% I'm talking about will hold true. It will always hold true. But for your own instruments, let's look at something. Yesterday, I was in this trade. I actually didn't get the entry right on this trade, right? Now, at this move, what happened was I was looking at this area and I was asking myself, where is the, because when you are drawing Fibonacci, okay, now we're going to focus on Fibonacci here because Fibonacci is very accurate. The reason I focus on Fibonacci a lot now is because Fibonacci is a very accurate tool to helping you analyze the market, very accurate. So I will encourage you that if you don't know how to use Fibonacci, understand how to use Fibonacci. You can use Fibonacci and just and just trade the market and relax. You can use Fibonacci, and all you do is use Fibonacci and just buy and sell where Fibonacci tells you to buy and sell, and you'll be making very good money. The only other thing you have to do is understand the trend, understand where market is going. So if you understand where the market is going, if you understand the trend and understand where the market is going per time, you'll be able to use Fibonacci to make money. The only way Fibonacci can fail you is if you got the direction of the market wrong, which means you got the trend wrong. If you get the trend right, if you take the time first of all to understand where the market is going, what is the new trend, you will not get it wrong with Fibonacci, right? So look at this. Now, I was somewhere here and I was looking at, because what happened was when this move happened, I was expecting a pullback from somewhere here, okay? This was what I was looking for. So you will notice that this is 61.8. Looking at this, you see what I'm working with now? I'm working with this area here. I'm working with this cell. This cell is what I'm working with now, right? So this area to this area is what I'm looking at, this cell now, right? Since I saw an impulse move here, since this is an impulse move, the last class we talked about impulse, okay? Since I saw this impulse move now, I was expecting Fibonacci to give me this move here. I was expecting sell. This is why I said that you have to understand the direction of the market before you can successfully, when you're using Fibonacci, all you need to do is understand the direction of the market. So this was what I was factoring in. I was expecting this to happen. But why did this not happen? Very simple. Non-farm payroll happened. Non-farm payroll happened. Actually, this move even happened, it made a move down. You will see that this move actually came down. It came down to this place before it continued buying. But non-farm payroll happened. When non-farm payroll happened, we're expecting a certain number to come out, because if it was forecast, this is what it is when you have to play fundamentals and technicals together. So you cannot be trading the market and not understand what the fundamentals are doing. Tomorrow there's going to be CPI. US CPI is inflation numbers is coming out tomorrow. So if you are trading any instrument at all, you want to make sure that you understand that CPI is coming tomorrow. CPI is coming tomorrow. So when CPI comes out tomorrow, the market is going to respond to CPI, whether you're trading gold or whatever instrument you're trading, NASDAQ, BTC, all of them, they are going to react to the CPI reports. And besides CPI report, there's also going to be Fed meeting, Fed minutes tomorrow evening. So all those things, you have to keep tabs on them. So what happened was that there was a particular NFP happened, non-farm payroll happened last Friday, right? And then we're expecting a number that is pretty low, but the number was not as low as the market expected. So instead of coming down, it did not sell. Instead of selling, it did not sell. It only sold a little bit, just a little, and then it started buying. So once this move happened, it was a clear, it was just clear that, hey, this was going to buy. So now, when that clarity happened that this is going to buy, here's where you want to use your Fibonacci. Let's remove this now, since this one becomes invalid. We measured this point to this area, this high to this low, right? Now that became invalid once that move didn't happen, non-farm payroll happened, this didn't come down, this move happened. Once this green candle moved massively up, we can see direction has changed, right? We can see direction has changed. When we exit this trade, we know that direction has changed. We know that price is going to buy, right? So what are we going to do next? We want to now use Fibonacci to get our buy entry, okay? So let's look at this. Now, this area is very likely, we are looking for whenever, like I said before, when you are looking for a sell, you are going to, when there's an impulse sell, price is moving down, you are going to pick a high and a low, a high and a low. You will draw your Fibonacci from top to bottom, from top to bottom. Now I'm repeating this so that for those who don't understand exactly how this tool is used, you can understand it better, right? 1 minute, guys. Okay, so that you can understand how this tool is used exactly, right? So when you are in a cell, you make sure that you're pulling your Fibonacci retracement, you draw it downwards. You draw it downwards, okay? Now, if you are in an uptrend, you are looking for a low, from a low to a high. If in a downtrend, you are looking for, if it's in a sell direction and you are looking to sell, you are looking from a high to a low. Your Fibonacci goes from a high to a low. If you are looking to sell, if you are looking to buy, your Fibonacci goes from a low to a high. Your Fibonacci goes from a low to a high if you are looking to sell.
Hello, sir. Is it from
buy.
100 to 0 or 0? Please use it. Make the
yes, I'm not going
way.
to use, no, I don't want to use 100. When you take this candle and draw it, that is down to, that is up to down.
The 100 will be on top now.
So that's the way you can look at it like that. I don't look at it from the perspective of 100 and 0.
Okay. Is it also possible for the 0 to be on top?
Okay, this is I just drew this now. Watch this. This Fibonacci is customized by the platform, not by you.
Yes.
Now look at this. If you do this and you draw it down here, you are seeing 1 on top and 0 below. This is top to bottom. So you look at it about how you understand it. I don't look at it. The only two numbers I'm looking at is this and the direction in which I'm drawing.
No, for us to get it right.
Yes, hold on. You hold on. You look, what you do is this. Look at how I'm showing it. Look for a way to understand it in an easier way for you.
And that's why I'm communicating with you, because if I don't understand it and I keep quiet, I will never understand it.
Exactly. So
all I'm saying is that there's a 0 and there's a 100.
Exactly. So hold on now. What you need to understand is this. I personally, I don't look at it in terms of 0 and 100. These are two things I look at. I look at the direction I'm going in. Remember, this platform, this Fibonacci tool does not change. It's not, you are not the one determining anything. The only thing you determine is what direction you are drawing it in and where you are, which direction, and then which high or low you are picking.
Sir.
You get the point now?
Can I say something?
Okay.
Are you saying even if the 0 is down or the 100 is up, it will still give us the same accuracy?
Okay, hold on. When you are talking about 0 and 1, you are confusing yourself. Do you understand what I'm saying now? Don't look at it in terms of 0 and 1, because that's not what's important here. Because if you look at it from 0 and 1, it will always confuse you. So don't look at 0 and 1. Look at two things I'm saying now. Number one, what direction are you drawing it in? Are you looking to sell?
I know my direction.
Hold on. You hold on now. Hold on. What direction are you drawing it in? Are you looking to sell or are you looking to buy?
Okay.
Fine. So what is your low? Okay, if you are looking to sell, you know that you are picking from a high to a low. So where the 0 is and where the 0 is not your problem. Where the 1 is or where the 0 is not your problem. Because like I said the other day, when you go to MT4, you will be seeing 0 and 100. That can be also confusing for you as well. So don't bother about 0 or 100. The only thing you want to look at is what direction am I going in? What direction am I going in? And then where am I pick? Where is my high and where is my low? That's what you're looking for. So now let's look at this now. This is you are looking to sell, right? Now you pick from, you identified your high, you've identified your low. Let's go like this. You pick it from here, you go to your low. So in this case, now you can see your 1 is on top, your 0 is below. That's not your problem. You're not bothered about your 0 and your 1, right?
Then do it the other way around.
Okay, fine. Let me do it the other way. So let's say you're doing this now. Let's just use the same. So you see 0, 1 here is 0. It's completely different.
Exactly. So that's why we
exactly.
must know where the 0 will be and where the 100
listen
will be.
to me. Listen to me. I'm the one teaching here. I am telling you the 0 and the 1 is not important. What is important is 2 things. Number 1, what direction are you going in? Number 2, where is your high and where's your low? Forget about the 0 and the 1. It will always confuse you if you look at it from 0 and 1. Just take it. That's what you need to do. Forget about the 1 and the 0. Focus on where am I taking it from? Where is my where direction am I going to, and where's my high and where's my low? That's what you just need to do. When you follow what I just told you now, you will never be confused with it. Never be confused with it. That's it. Right? You will never be confused with it, because if you follow 0 and 1, you will have issues. Now, you want to buy in this, now there's a sell. Now you want to buy here now, we know that this is a buy. Like I said earlier, this area was broken, so you know that is a buy you are looking for, right? Now let's assume, let's first of all notice that this, let's look at this area. Okay, no, I'm not able to do this because I need to upgrade. Okay, so let's leave that. Now, where this massive candle is, this impulse candle, please mute yourself, thank you.
Okay.
Yes. So where this impulse candle is where, let's ignore that part now. Now, what we want to do now is we want to identify a low and a high, because we know that we are going to buy in this scenario. Okay, we're going to look at several instruments, but let's just look at this first. We're looking at a low and a high. Which low are we going to look at? Where's the high? Where's the low? Sometimes it's very easy, just like here, just like this point now, just like this point, just like this point and this point. It's so easy. This is a low, this is a high, very straightforward. But sometimes, and this area now, look at this is a high, this is a low, very straightforward. Okay, now in some cases it can be a bit confusing because of the way the candle formed, right? Because of the way the candle formed. So in this case now, you might be looking at where is the low and where is, we can see, now remember I said ignore this large candle here. We are looking to see an entry. We are looking to get an entry. Please mute yourself, please. Thank you. Mute yourself. Okay. So we're looking to get an entry. Hold on. Let me clear this so that I don't So now we're looking at this huge candle is not there yet. We are looking for an entry somewhere here because we are looking for a buy. We can see this candle has already formed. This one, you can see this candle has already formed. Okay, now we see that this area here, which was a retracement, is broken. So we know that this price is going to go up. So where are we going to now enter the trade? This is where I personally I'm looking at this area as a low. This area as a low. This high is pretty clear. Price starts coming down from there. You know that that's a high, but the low is a little bit confusing. But eventually, if you look carefully, you will realize that this area was a low. And actually on this trade, I missed this low yesterday. I missed this low. I was trying to get the low. Initially, I thought this was the low, but eventually I realized that this was the low. Okay, so when you pick the Fibonacci and you put your Fibonacci here and you draw it, you realize how it got into the 61.8 and from there it bought. So you will see this over and over and over and over all the time. That's the reason why I say that what you have to do is just know exactly which direction you're going in, okay, by knowing the trend, what's changing. was not changing, because if this didn't change, price would have come right down here. You can see how I drew this here. You can see the trend line I even drew. I was expecting price to sell all the way to this area before buying. But because non-farm payroll happened, that news happened, then it couldn't sell anymore, it started to buy. It couldn't sell, it started to buy. Right? And when you look at the dollar index, like I said, the dollar index is also something you want to be watching whenever you're trading any instrument that's connected to the dollar, which is basically almost every instrument, except you're trading crosses. Okay? Maybe you're trading.
No, I cannot see your screen.
You can't see my screen.
No,
you can't see my screen.
I can't.
Oh, wow.
Your screen is showing. It's showing. Your screen is showing. You should reconnect.
Okay, please, can you disconnect and connect back?
Oh, all right,
Yes.
it's
Disconnect and connect back, please. Thank you.
oh yeah, it's back now.
Okay, fine. Please mute yourself. Thank you.
Okay, thank you.
Okay. All right. So so now you want to be looking at the dollar index. What's happening with the dollar index? Because once the non-farm payroll came out, that's when this dollar index started making moves. I think this was when this huge candle, it happened somewhere here, I think somewhere here, and it just kept pushing up, right? So when you're looking at what's happening on the dollar index, when you look at dollar index, for example, you will notice the dollar index somewhat has almost, in some cases, you will discover that the dollar index has an opposite relationship with the Euro USD, like almost an inverse relationship with the dollar index, with Euro USD, almost exactly in some cases, right? But in some cases, it doesn't have the movement doesn't look exactly opposite, but it's still the same thing. When the dollar index is buying, Euro USD is going to sell. When Euro USD is selling, dollar index is going to buy. It's the same thing for GBP USD. It's the same thing for gold. Just that it may not mirror it perfectly. It may not mirror it to the T. It may not mirror it to every candle. That's what I mean. You may not see this buy candle now, and then you go to Euro USD and you see that exact sell. You can see now what I'm saying. You can't see this buy candle now, green candle, and then you go to Euro USD and you see a red candle just to make it opposite. No, it doesn't do that. Sometimes it actually does that, but sometimes it doesn't do that. But what you're looking for is direction. The direction is what you're looking for, right? So usually when the dollar index is strong, Euro USD will be, when the dollar index is strong, USD JPY will be strong, especially USD JPY. And the reason why USD JPY is like that, because you will not see this kind of relationship I'm talking about now with the USD card. You will not see that with the USD card. It's a bit different with USD card. What the pair that mirrors the Euro USD, the dollar index very well is USD JPY. And the reason for that is that the JPY is sort of a very stable instrument. It's a stable currency. The JPY is a stable currency because of what the Central Bank of Japan does. The JPY currency itself doesn't have too many volatility. That's why when you go to Forex Factory, you will hardly see news events that from Japan that affects the JPY. You don't see it much. Most of the time, you don't see it. Right? It's very hard for you to see a news event and you say, oh, this news event affected JPY. It's very difficult. Most of the time, you won't see that. Right? So that's why you find out that the dollar here is only in certain cases where they are trying to intervene. Maybe the dollar is getting too strong against the JPY, then the Bank of Japan is trying to intervene to just at least stabilize the JPY currency. That's when you see those kind of moves. But besides that, what you see mostly in the dollar is what you will see reflecting in the USD JPY. Okay, because the dollar index is the dollar itself. So it's just the chart of the dollar. The dollar index DXY is the chart of the dollar, right? So what you will see that all the time. Now, in this case, in this particular case you are seeing right here, at this time, the price did not get to. This is This would have been the Fibonacci retracement movement for this, where I would be expecting, in fact, I was expecting price to come to this point. This is the 1.8 to buy, but you see that price didn't get there. Now, this can happen once in a while. This can happen once in a while. Sometime for a long time, for quite a while, I haven't even seen this kind of movement, right? So this can happen once in a while, and it happens usually when the movement, when there is a strong bullish movement or there's a strong bearish movement. So you're expecting price to come to a certain area and price doesn't get there yet. Just understand that price doesn't get there yet. Eventually, price will still come there. Maybe on the second leg of this movement, because right now it is estimated that price is going to come to around 135.00, which is about over 100 pips from where price currently is right now, right? Yeah, about 120 pips from where price currently is right now. Once that happens, the Fibonacci retracement at that time is going to definitely hold. The only thing you have to check for that time is this: where is the direction of the market? Is the market changing direction? If the market changes direction, that's the only way Fibonacci will not hold. But if the market doesn't change direction at that time, Fibonacci will definitely hold. So those are the things you're actually looking for. What direction is the market? What trend is the market in right now? Then am I buying or am I selling? What is my low and what's my high? Those are the things you want to look at in the market, right? So pick your instrument, like I said, pick your instrument very well and then analyze. For example, I looked at gold this morning, or something I saw on gold. You can see gold also responds to the 61.8. You will notice that, look at the gold stuff I did. I just did this, I think last week or so. And then I just got there and discovered that price actually respected the 61.8 on gold. Now, I haven't analyzed so much on gold like that. I don't think this happens all the time, but I know it happens a lot of times. Okay, I don't trade gold. Okay, now let's do something. Let's pick this low and this high. And let's see if we have anything from there. Okay, this is a high. Okay, this is a low right here. Watch this. This is a low right here. This should be the low. This area should be the low. These two areas should either be the low. Then we have the high here. Okay, so it's something you have to look at very carefully, because what is the recent low? Now, we are not looking at all this. I'm just trying to, this is a back test now. Okay, what this movement here, where did this get to? This is what I'm trying to notice. This is how you back test your instrument, whatever instrument you're trading. You want to know what actually works for this instrument I'm trading. So is it 61.8? Is it 50%? If you use Fibonacci on your instrument that you're trading and you discover Fibonacci doesn't work from back test, then you look for another strategy to trade it with. But I can tell you that from what I have seen, even BTC, I can use Fibonacci to trade BTC excellently. Right? So this is that's my experience. Okay. So let's look at this and see where are we drawing it from. Okay. Okay, so let's see where this is happening. Okay, so obviously this is not the structure right there, because this is another challenge you might encounter. This is another challenge you might encounter. Exactly where exactly is my high and my low? But that is something you will determine based on the instrument you are trading. That's the reason why I keep hammering on what instrument are you trading? What instrument are you trading? Because if I'm trading, I don't trade gold. For USD JPY that I trade, I know exactly where to pick my lows and highs from. I know where to pick my highs and lows from, right? I know that when I'm picking my highs and lows, it is best. It is usually the best if I pick them on the 4-hour chart. Now, in some cases, the 4-hour and the 1-hour will come together. I just missed this trade now that is running. But I don't really bother about it because he hasn't come to my entry. So because he hasn't come to my entry, I'm not really going to be bothered. This is my entry right here, right? For my entry, this is where I'm expecting to buy from. I'm expecting price to push down to this place and buy from this bottom here all the way to this top. This basically my target. I want to see price buy from here, somewhere around here, all the way to this top here. Excuse me. Whereby 150 pips. Now, I am not sure that that's going to happen, but if it does happen, that is the target that I have for USD JPY, right? So I'm looking at, I did my Fibonacci here, and I'm expecting price to come to this area. And if you notice, you will notice that this is also a structural breakout. If you know how to identify structural breakout, this is also a structural breakout here. Exactly where the 61.8 is. That's also a structural breakout, right? So the only thing, like I said before, the only reason price may not come to this area, just like in this case, it didn't come to this area, is when there's a very strong bullish movement in this case. And you can see the way this movement happened, very strong bullish movement. So that strong bullish movement is the reason why you may see that price doesn't come to that area at the moment. But that doesn't mean it's not going to go there. It's still going to go there, but at a later point, at a later time. But at that later time, I have to then look, first of all, at the overall direction of the market. What is the trend? Is the trend positive? Is the trend negative? Is the trend positive? Is the trend buying? Is the trend selling? Before I determine to enter that trade at that time. Okay? So this is the thing you want to look at. The gold we're looking at before. Look at the gold we're looking at, right? So as you trade your instrument, look at, if I take this from this bottom, if I take this from this bottom to this top now, you can see that the Fibonacci came to the 61.8 here. So I'm not trying to make it up. I'm not trying to make it up. Your instrument is what determines when you focus on a particular instrument, you'll be able to know exactly which area to pick for a high and for a low. Which area should I pick for a high and for a low? That's what you have to know from your own instrument. Okay, so that will determine your understanding. This is the reason why you can't just come into the market and trade as many things as you like. You can't just trade as many things as you like. So look at this. So I took this top, this bottom now to this top. You can see it broke out of the Fibonacci 61.8. It didn't hold. It didn't hold. But for the instrument that I trade, this kind of thing really doesn't happen. I have really not seen one area where this kind of thing happens, where the 61 did not hold. I don't know, from back test, from front test, from my trading, I haven't seen where this did not hold. If it didn't hold, that means there's something I'm not getting right. That's the reason why, because I don't trade gold, I have not investigated this to see very clearly, oh, this is how this works here, this is how it's. So I'm just doing this right now as I'm here on this point. So you can see that sometimes it holds on the 61.8, like it did here, like it did on the first one we did. Sometimes, like on this case now, it didn't hold. So the question is, the same thing will go for USD, GBP USD. The same thing will go for Euro USD. That's the reason why your first thing you want to do is pick the instrument you are going to focus on. All right. Do we have any questions? Do we have questions we want to ask?